Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is a special edition where our focus is on the earnings. And LTI Mindtree, the sixth largest IT services firm, has reported a sequential rise of about 1% in the net profit to 1162 odd crore rupees. The revenues from operations have grown sequentially 2.3% to 8905 crore rupees. To discuss more insights on the Q2 earnings and as well as the outlook going forward, I'm now joined by the top management of the company. Nachiket Deshpande joins in. He's the Chief Operating Officer of LTI Mindtree. Very welcome to Business Today Television, sir. And thank you so much for taking the time out for this discussion as well. Let me kickstart by asking you, what is your own reading of the demand trends on the ground? We had been hearing constantly about the slowdown in the developed markets where a large part of your revenue comes from. What is the situation on ground? Have you seen some kind of an impact on both your top line and bottom line on the slowdown front?
Thank you for having me, Sakshi. So as we said, I think we continue to see cautiousness in the decision making from many of our customers. So I think that definitely hasn't gone away. The macro conditions and the geopolitical situations that are developing very recently also does not give any confidence of that changing anytime soon. So from our perspective, I think customers continue to remain cautious. They continue to look at the programs and initiatives that are going to give them immediate return on investment in terms of what they want to deliver. So they continue to prioritize those investments that has the ROI that they're looking for. And we've also seen as a result of that, a higher number of opportunities, and our pipeline is made up of deals where customers are looking for generating more cost savings through productivity, through vendor consolidation, through adopting newer technologies to save costs. So a large part of our pipeline, a large part of our conversations with our customers are now centered around helping them generate better productivity. And going into next year as well, while it's too soon to talk about the budgets, as most of our customers with Jan to December financial years are now entering that conversation in their respective organization. But I think the indication is that they don't see that situation changing, at least going into the next year. And hence we'll continue to see similar pattern where a large part of our pipeline would be cost saving and efficiency related opportunities.
Okay. We've been seeing your larger counterparts as well. Most of the IT firms have slashed the revenue guidance across the board as the growth is sputtering. Are you also somewhat cutting your guidance for the entire fiscal year and for the next year too?
So we don't give revenue guidance. But at the same time, I think we've indicated in our earnings call as well that as far as we are concerned, we are expecting a stronger H2 than H1. So for us, we do believe that over the next 2 quarters, we will see improvement in our sequential growth prospects, and hence we'll be able to deliver better results in H2. And that is purely based on the deals that we have closed and the pipeline that we see, right? It's not that we expect any changes in the macro environment, but it is more on the basis of how we see our deal situation.
Right. You've reported about an order inflow of $1.3 billion in Q2, which is slightly lower than in Q1, but up 20% on a year-on-year basis as well. But this is the dichotomy that we are looking across the board. Strong deal wins, but weaker billings across the industry. Is that something, and why is that really happening? Could you explain to us?
So normally that happens because the deal, while the new deal wins is strong, as I said, with the cautious environment from our existing customers, there is a significant drop in the discretionary spending by them. And that means some of our existing programs, as they come to a close, you may not see renewal of those, or you may see spend reduction in some of these transformational programs by customers based on what they are seeing as the budget situation going into next year. So while you have new revenue streams that are starting with the new deal wins, that essentially compensates for the reduction in the existing business with your existing customers. And that's why you may not see that in the growth in the overall revenue numbers. As far as we are concerned, I think as we see that many of our challenges with respect to existing spend being moderate are also sort of bottoming out, and we see, as I said, in Q3 we'll still see some higher furlough. But beyond that, we see that the deals wins that we have done, which are ramping up, will give us that revenue uptake in Q4 especially, and that gives us the confidence on the H2. So you will start seeing that in the revenue numbers as well in the subsequent quarters in our result.
Okay, so let's talk about margins a bit. This quarter included the impact of your wage hike cycle as well. It did have an impact on the EBIT margins as well. We've seen a 70 basis points of a dip to 16 odd percent. But Q3, like you said, there is a seasonality impact. You're expecting higher furloughs as well. Do you see margins to be softer in Q3 before they pick up? And what would be your entire guidance for margins for the fiscal year?
So what we have guided is we would exit this financial year with an EBIT margins between 17 to 18, and that we feel confident of. The reason for our confidence is we had started our margin optimization initiatives in the company after the merger, and we are starting to see the result of that. We're starting to see the benefits of that accruing, and hence, while normally an increment has roughly 200 basis point impact on our margin in that quarter, we were able to recover almost 130 basis point out of that impact. As you see, only 70 basis point has been an impact this quarter. So that confidence that those margin optimization initiatives are now delivering the savings, we feel that despite of higher furloughs, we should be able to recoup those as we go into Q3 and Q4, and hence our guidance on Q4 exit. Now, whether Q3 will be higher or lower, as I said, we don't guide specifically for a quarter margin, so we would look at that. But I think the Q4, the confidence is there that we'll be able to exit with that 17 to 18% margin.
Okay, fair enough. So the other important point that we've been noticing as a trend across the IT board results that we've been seeing is the reduction in the headcount number. Even you have added about 794 employees, taking the total headcount to 83,532. In Q1, however, the headcount had declined on a sequential basis. How do you see this panning out for the rest of the fiscal year? Even though attrition is improving quarter on quarter, is the headcount going to be a concern that one should monitor?
So when we had talked about post-merger, we had already indicated that as the two companies are coming together, we would now have an ability to utilize our bench better. And hence, you should not look at headcount addition as a reflection of business as far as LTI Mindtree is concerned post the merger. And we had said about 2 to 3 quarters, we will, be able to, as systems come together, we have a better visibility of talent availability, and hence we'll be able to deploy them better. And you see that reflected in our utilization improvement from last year Q3 to Q4 to Q1 to Q2. And as we have now improved our bench utilization, we will now see a net headcount addition going forward in line with our business growth. So from our perspective, we don't expect subsequent quarters to have net headcount reduction, because we are at an optimum utilization. We wouldn't want to take it beyond that. So and hence proportionate to our revenue growth, you will see the headcounts also moving up in the subsequent quarters.
Okay, got that. What about the hiring trends, sir? Are they going to be on track as how the trend has been over the last few years, or is there going to be an impact on that as well going forward?
So on the hiring trend, as I said, we don't sort of target a particular headcount, right? It is a reflection of our business growth that we see. There are two things that are helping the hiring situation for us. Number one is, of course, as you said, attrition is has moderated significantly as compared to last year. So that helps in ramp up, because we're not backfilling as many resources as we used to in the past. The second thing is that because of the market conditions, now availability of talent has also improved, and which means that we are able to hire the skill sets we want, more just in time, closer to business opportunities. So we don't have to proactively build a bench in anticipation of the work, but we can do that as the work is known to us. And also, so we will continue to see that trend, and hence we are able to maintain utilization and ramp up in in relative to our business growth. As far as our fresher hiring is concerned, I think we have onboarded, we talked about, I think 1400 odd freshers we onboarded in this quarter. And for the rest of the year also, we are on track with what we had planned for FY24 onboarding of freshers.
Okay, so let's talk about the geographical revenues as well. Revenues from your largest market, North America, which accounts for 73%, has grown 6%. Europe has grown 10.2% as well. What's the outlook here? And if you could also detail for us if there is any kind of trend changing that one should look at.
So I think US for us continues to be a dominant market, and I don't think short term that will change. It continues 72% of our revenue is coming from North America. We see broad-based growth across industry segment, and hence that will also be reflected from a geography perspective as well. For us as well, I think given a smaller base, but otherwise as well, we are seeing a slightly better traction in Europe. As you see, that's why our Europe growth was better. I think same trend is likely to continue in the subsequent quarters as well. So we don't see a huge shift in the pattern for us going into the next 2 quarters also.
Okay. And, when we talk about your various business verticals, banking, financial services, insurance, they've reported a marginal decline on sales, if I'm not wrong, on a sequential basis. What about going forward from here? Which are the verticals that you believe emerge as the strong levers for you for substantial growth uptake?
So I think for us in the next 2 quarters where we indicated for growth, our growth will be broad-based. So we'll see all verticals participate in that growth. And BFSI being the largest segment for us, it's difficult if it does not participate in that growth, right, to meet that growth demand. So I think we see that we'll see a growth there as well. And even within BFSI, I think we'll need to look at BFS and insurance separately, because even in this quarter, our insurance growth was robust. And I think we see a similar trend in the next 2 quarters as well, while BFS does see a pressure from most of the banks looking at a significant cost reduction. But we, at the same time, we have few deal wins in BFS as well, so it will sort of compensate each other. But we see insurance maintaining resiliency and the other verticals also participating in it, including high tech, manufacturing, and all of that participating in for that next 2 quarter growth.
Oh, fair enough, sir. And many thanks then, Mr. Deshpande, for being with us on the show and sharing all these insights from the quarterly earnings. All the very best to you for the upcoming quarters, and we shall hope to catch again to understand more about the business insights and the outlook going forward as well. Pleasure having you with us.
Thanks for having me, Sakshi.
All right, and with that, we will wrap up this special edition on earnings. But do stay tuned onto Business Today Television to catch all the updates from the world of business and stock markets going forward.
If you like the video, do like, comment, share and subscribe.